There is something happening in the gold market right now that most people have no idea is going on. And I don't mean the usual back and forth about whether it's going to go up or go down. I'm talking about something far bigger, something structural, something that once it reaches its conclusion, we'll look back at this moment the same way historians look back at 1971 or 1933 or even the fall of the British pound as the world's reserve currency. I'm talking about a convergence of forces, monetary, geopolitical, institutional, and technical, that is quietly building underneath the surface of this market like pressure beneath a fault line. And when it finally releases, the move gold makes will be unlike anything we've seen in 100 years. So, if you've been sitting on the sideline watching gold and wondering whether you've already missed it, I need you to stay with me through this entire video. Because by the end, you're going to understand exactly what's happening and why the people who understand it earliest will be the ones who benefit most. Let's start with where gold actually stands right now. The metal hit an all time high earlier this year, a price level that would have seemed absolutely unthinkable to the average investor just a couple of years ago. And since that peak, we've seen a pullback. Gold came off its highs, and if you were following financial headlines, you probably saw the usual talking heads come out and say, the gold rally is over, the trade is done, investors are rotating out. And here's the thing, that narrative is not only wrong, it is dangerously wrong for anyone who believes it. Because what these commentators consistently fail to understand is that in every single major gold bull market in history, the biggest pullbacks didn't signal the end, they signaled the setup. They were the last train station before the rocket launch. Think about what happened in the 1970s. Gold was liberated from its fixed peg in 1971 when President Nixon closed the gold window, essentially severing the final link between the US dollar and physical gold. In the years that followed, gold went on a run that stunned the world. But it wasn't a straight line. There were pullbacks that shook out weak hands. There were moments when the mainstream financial press declared the rally finished. And yet, from 1971 to the eventual peak at the end of that decade, gold delivered one of the most explosive gains any asset class had ever recorded. The investors who held through those pullbacks, who understood the underlying structural shift taking place, were rewarded beyond anything they could have imagined. Now, I want you to hold that historical parallel in your mind as we walk through what's happening today, because the structural forces at work right now are eerily similar, and in several key ways, they are actually more powerful. Before we go deeper, real quick, if you're someone who's been looking for a simple, no fluff breakdown of how everyday Americans are protecting their retirement savings with precious metals, I put together a free guide, and it's in the description below. Thousands of American retirees have already used these strategies to add a layer of protection to their hard earned savings, and it costs you nothing to take a look. Check it out when you get a chance, and then come back here because we're just getting started. So let's talk about what is actually driving this setup, because it goes much deeper than inflation is high or the dollar is weak, though both of those things are true and matter enormously. What we're really talking about is a fundamental rewiring of the global financial system. And this rewiring is being executed not by retail investors, not by gold bugs on the internet. It is being executed by central banks, the most powerful financial institutions on the planet. Institutions that have access to information and analysis that the average person never sees, and institutions that move with tremendous deliberateness. When central banks move, they don't move on a whim. They move because they see something coming. And right now, central banks around the world are buying gold at a pace that has shocked even the most experienced analysts on Wall Street. Goldman Sachs, not exactly a fringe institution, put out research revealing that central banks have been buying as much as 70% more gold than the official numbers suggest. 70% more. The discrepancy exists because of a gap between what's leaving the London vaults and what's showing up in official export data. In other words, someone is quietly accumulating physical gold on a massive scale, and they don't want the world to know the full extent of it just yet. Think about what that means for a moment. The entities with the deepest pockets and the longest time horizons on Earth are systematically, deliberately moving their reserves into gold. Poland, China, Uzbekistan, the Czech Republic, country after country, quarter after quarter. The World Gold Council confirmed that central banks collectively purchased hundreds of tons of gold in just the first 3 months of this year alone, representing a 17% increase from the prior quarter. That is not a blip. That is not a one-time rebalancing. That is a sustained, coordinated, structural shift in how nations are choosing to store their wealth. Now, let me connect this to the bigger picture, because the why behind all of this central bank buying is what reveals the scale of what's actually coming. We are living through the early stages of a de dollarization that has been building for years but is now accelerating visibly. And when I say de dollarization, I don't mean the dollar is about to become worthless tomorrow morning. I mean the dollar's share of global reserves, global trade invoicing, and global financial transactions is declining in a way that is now statistically undeniable. Let me take you back to the 1920s and 1930s to paint a picture of what this actually looks like when it happens. The British pound sterling was, at its height, the world's reserve currency, in the same way the dollar is today. The entire global financial system was essentially denominated in pounds. And then came the First World War, then the Great Depression, and suddenly Britain found itself with an impossible debt load, a crumbling industrial base, and competitors rising on all sides. The transition away from sterling to the dollar took decades, but once it crossed a certain threshold, it became self-reinforcing. Countries that held pounds started quietly diversifying, then more quietly diversifying, and then one day it was simply over. Britain never recovered that status. The pound never recovered its former purchasing power. And the countries that had the wisdom to hold assets that couldn't be inflated away, gold primarily, preserved their wealth across that entire transition. Here's the critical parallel. The United States today bears a striking resemblance to Britain at the moment its monetary dominance began to erode. A debt load that has grown to staggering proportions, a manufacturing base that has been hollowed out over decades, geopolitical competitors, particularly China, Russia, and the broader BRICS coalition, openly working to reduce their dependence on dollar-denominated trade. The BRICS nations have now openly discussed alternative reserve assets, alternative payment systems, and alternative ways to settle international trade that don't require dollars. And meanwhile, US inflation running above 4% signals that the Federal Reserve is struggling to thread a needle between fighting inflation and managing an economy that has become deeply dependent on cheap money. All of this creates the conditions for gold to do something it hasn't done in a very long time, something it has only done at the hinge points of monetary history, something that fundamentally revalues the metal to reflect a world where confidence in paper currency systems is genuinely shaken. Let me tell you a story about August 15th, 1971. That was the Sunday evening when President Nixon went on television and told the American public and the world that the United States was suspending the convertibility of the dollar into gold. The Bretton Woods system, which had underpinned the entire global financial order since the end of World War II, was over. And what happened to gold after that? It went from a fixed price of $35 per ounce to over $800 per ounce by the end of that decade. That is a gain of more than 2,000%. 2,000% in roughly 8 years. Now, I'm not here to tell you that gold is going to repeat that exact move, but I want you to understand the mechanism, because the mechanism is identical to what's happening today. In 1971, the shock was that the dollar was no longer backed by anything tangible. The world had to process that reality, and it took several years for the full implications to be priced into the gold market. Today, we are in the middle of a different but equally profound realization that the dollar's dominance is declining, that US debt is on an unsustainable trajectory, and that the fiat monetary system globally is under the most significant structural stress it has faced since that era. And just like in the early 1970s, it takes time for these realities to be fully priced in. Now, here is where this gets really interesting from a technical standpoint, because we're not just talking about the macro story. The supply side of this equation is equally compelling. Gold is not being discovered at anywhere near the rate it's being consumed. Major new gold deposits are extraordinarily rare, and the ones that do exist take a decade or more and billions of dollars to bring into production. Meanwhile, mine supply, the actual amount of gold being pulled out of the ground each year, has been essentially flat or declining. You've got a situation where demand is structurally increasing, from central banks, from Asian consumers, from investors seeking inflation protection, from technology applications, while supply is constrained. That's the kind of fundamental setup that doesn't just produce a temporary rally, it produces a sustained, multi-year repricing. And then there's the paper gold problem. Most of the trading volume in gold markets doesn't involve actual physical gold. It involves contracts, futures, ETFs, and derivative instruments that represent claims on gold. Estimates suggest that for every ounce of physical gold that exists, there are dozens of paper claims on that gold. Now, this system works fine as long as nobody actually demands delivery, as long as everyone is content to trade paper back and forth. But the moment confidence in these paper instruments wavers, the moment enough investors and institutions decide they want the real thing, not a claim on the real thing, you get what's known as a short squeeze on physical gold that could send the price of actual metal to levels that would seem extraordinary from where we stand today. And here's what's fascinating. The very central banks I mentioned earlier are not buying paper gold. They are buying physical gold. They are taking delivery. They are moving metal from vaults to vaults. That distinction matters enormously because it tells you exactly what these institutions, with their armies of economists and their direct lines to government intelligence, are preparing for. So let me now talk about what all of this means for you, specifically if you're at or near retirement. Because the people who are most exposed to what's coming are people who have spent decades building wealth denominated in dollars. People who have 401ks and IRAs filled with stocks and bonds, assets that have their value denominated in the very currency system that is now under structural pressure. And I want to be absolutely clear. This is not a doom and gloom message. This is a strategic reality check. Because the same way that educated investors protected their wealth through the monetary upheavals of the past, you can protect yours right now. One option that's quietly gained enormous traction among financially savvy retirees is the Gold IRA, a retirement account structure that allows you to hold physical gold within a tax-advantaged retirement account, without penalties, without losing the tax benefits you've spent decades building. It's not complicated, it's not exotic, and it doesn't require you to liquidate everything you have. It's simply a way to add a layer of physical, tangible asset protection to a portion of your retirement savings. The same kind of protection that central banks around the world are currently scrambling to acquire for themselves. If this is something you're curious about, the free guide in the description breaks down exactly how it works and what you need to know. I put it there for a reason. Now, let me come back to the markets because we haven't finished the technical picture yet. What the charts are showing right now is a pattern that experienced technical analysts call a high-level consolidation. Gold made an extraordinary run, hit its all-time high, and then pulled back. The question the market is wrestling with, the question that's creating this consolidation, is whether this pullback is a reversal or a reload. And when you overlay the fundamental picture I've described on top of the technical pattern, the answer becomes increasingly clear. Every single major bank and financial institution that covers gold, JP Morgan, Goldman Sachs, Wells Fargo, Morgan Stanley, UBS, has maintained bullish year-end price targets that are significantly above where gold is trading right now. Not one major institution has called this a structural reversal. The consensus view among the most sophisticated analysts in the world is that this pullback is a consolidation, and that the path of least resistance remains higher. JP Morgan is targeting prices that would represent a move well above the previous all-time high. Goldman Sachs has raised its own target twice in recent months as central bank buying data came in stronger than expected. And the World Gold Council's own analysis projects scenarios where, if geopolitical risks escalate further or Fed policy dovishness returns, the gain from current levels could be 30% or more. But here's what I really want you to understand about the 100-year framing. The last time we saw the specific combination of factors now present in the gold market, extraordinary sovereign debt levels across the developed world, a declining reserve currency, accelerating central bank gold accumulation, deteriorating geopolitical order, and a retail investor base that is still massively underweight gold, was the period between the two world wars. The 1920s and 1930s were a time when the old monetary order was dying and a new one hadn't yet been born. Gold in that environment wasn't just an investment, it was the only universally recognized store of value in a world where the credibility of paper money was being shattered. We are not in the 1920s, but we are in a period that rhymes with it in unsettling ways. The BRICS nations now represent over 40% of global GDP. The U.S. national debt has crossed a threshold that many economists describe as genuinely destabilizing. The Federal Reserve is navigating an environment where fighting inflation means risking a recession and a financial crisis, while tolerating inflation means continuing to erode the purchasing power of every dollar-denominated asset. There is no clean answer. And in environments with no clean answer, gold has historically been the only truly neutral asset. The only thing that holds value when every other asset is being compromised by the policy decisions of its issuing government. Think about the story of any nation that has gone through a significant currency crisis in the last century. Argentina, Zimbabwe, Venezuela, Turkey, Weimar Germany. The pattern is always the same. First comes the denial, the assurance that the fundamentals are strong, that the currency is sound, that the inflation is temporary. Then comes the visible cracks, inflation that accelerates beyond projections, capital flight, declining confidence in the banking system. And then comes the repricing, the sudden, violent recognition that the paper assets people thought were valuable have been systematically degraded. And in every single one of those stories, the people who held gold, physical gold, emerged from the crisis with their wealth largely intact, while everyone around them watched theirs evaporate. Now, the United States is not Argentina. The dollar is not going to hyperinflate tomorrow. But the directional pressure toward more debt, toward more money printing when crises hit, toward the steady erosion of purchasing power, that directional pressure is undeniable. And when you project that pressure forward over the 10 or 15 or 20 years of a typical retirement horizon, the question isn't whether gold matters. The question is why anyone would choose not to have any. Here's something that doesn't get talked about nearly enough. The gold to silver ratio, the number that tells you how many ounces of silver it takes to buy 1 ounce of gold, is sitting at a level that historically has preceded powerful moves in both metals, but especially in silver. We're in a range that has, at every comparable point in history, ultimately resolved with silver outperforming gold in percentage terms as the bull market matures. Silver has the dual benefit of being both a monetary metal and an industrial metal, with enormous demand coming from solar energy, electric vehicles, advanced electronics, and industrial applications that are growing rapidly. The supply constraints in silver are actually more severe than in gold, and yet silver trades at a fraction of the price that its historical ratio to gold would suggest. This means that investors who are late to the gold story may actually find the best leverage in silver, the younger sibling that always runs last in the precious metals bull market cycle, but often runs hardest. And then there's the institutional demand story, which is still in its early stages in terms of retail allocation. When you look at the data, the average American retiree's portfolio has virtually zero direct exposure to precious metals. Pension funds globally are allocated to gold at levels far below what historical performance models would suggest is optimal. Endowments, sovereign wealth funds, family offices, the smart money have been quietly increasing allocations. But the wave of retail and pension fund money that typically marks the final parabolic phase of a major gold bull market, that hasn't arrived yet. We're in the middle innings at best. The late innings, when gold shows up on the front page of every newspaper and every taxi driver has an opinion on it, that's when a top typically forms. We are nowhere near that. Let me leave you with this thought. In the 1960s, before Nixon closed the gold window, there were a handful of economists and analysts who were watching the same data I've described to you today. They could see the cracks forming in the Bretton Woods system. They could see that the US was accumulating too much debt to maintain the gold peg. They could see that the European central banks were quietly exchanging dollars for gold from the US Treasury at the fixed rate while they still could. And the investors who listened to those analysts, who positioned themselves in physical gold before the August 1971 shock, walked into the decade that followed already holding one of the best performing assets in human history. We are at a similar inflection point right now. The warning signs are the same. The structural forces are the same. The institutional behavior is the same. And the opportunity for ordinary investors to position themselves ahead of what's coming, rather than scrambling to get in after the fact, is still very much alive. The move that gold appears to be setting up for is not a trade. It's not a speculation. It's a recognition of monetary reality that the market is slowly but inevitably being forced to price in. And when it does, when the full weight of all these forces converges at once, the move gold makes could genuinely be one for the history books. Not the history of this year, the history of this century. Now, if you've watched this far, I want to make sure you know about something. The free guide in the description isn't just general information. It's a specific, practical breakdown of how American retirees with $100,000 or more in retirement accounts are legally, tax-efficiently adding physical gold protection to their portfolios. And if you mention this video when you reach out through that guide, you'll get access to a complimentary one-on-one educational consultation. No obligations, no pressure. just a conversation about your specific situation and how these strategies might apply to you. That offer is exclusively for people who've watched through to the end of this video, which you just did, and it's exclusively for American retirees with $100,000 or more in any retirement account. The link is in the description. Use it. The opportunity I've described in this video doesn't wait forever.